If for the last week all you've been hearing has been stocks, hedge funds, Citadel, GameStop, Robinhood, short squeezes, call options, and you're asking everyone that you know, can you explain this to me like I'm 5? You're not alone and you're in the right place. In this video, I'll be going over exactly what's been going on so you can explain it to your other 5-year-old friends and sound like a genius. All I ask for in return is that you smash the like button and subscribe to the channel. Before we start, a quick disclaimer. Anything that I say is not financial advice or trading advice. Trading comes with extreme financial risk and you should always do your own due diligence before trading. Alright, so let's start with the basics. Shorting. You would short a stock if you think the price of that stock would go down in the future and you wanted to make money off that prediction. The way you do this is by borrowing that stock from your broker, selling it at the market value, and then in the future buying it back at hopefully a lower cost so you could profit, and then you give that stock back to your brokerage. That's how you make money shorting a stock. But just like anything with investing, nothing is guaranteed. And sometimes price goes against your plan. Short squeeze is another term that I'm sure you've been hearing. A short squeeze is what happens when a heavily shorted stock, like GameStop, price doesn't go down and actually rallies higher. When a stock price rallies, new buyers will step in to profit from the momentum. But with short squeezes, it's not just new buyers stepping in. It's also the people who had short positions that are trying to close the trade out. And the only way a short position can be closed is by buying that stock back. So there's two different types of buyers, bidding the prices higher. And as the price runs higher, we get more people buying the stock and short traders covering their positions. If you're a short trader and respect risk, you're going to want to close the position before it becomes a huge loss. And during these short squeezes, when there's so many buyers and so few sellers, the price explodes. So that's the basics behind what happened with GameStop, BlackBerry, AMC, and now American Airlines this week. But here is where it gets really entertaining. Typically, the battle between shorts and longs are played out between different hedge funds. But this was a true David versus Goliath story. But you have to replace David with Wallstreetbets and Goliath with Melvin Capital. You see, Wallstreetbets is a group on Reddit that, through their own research, found out that Melvin Capital had a very large short position on GameStop. Many people on Wallstreetbets grew up loving GameStop, and it sickened them to see Melvin Capital profit off their demise. So they put their money, and all of their money, where their mouth was. Wallstreetbets band together to bid up the price of not only just GameStop, but other heavily shorted stocks such as BlackBerry and AMC. As those stock prices rose, more people got in on the long side, not just Wallstreetbets. The more people heard about this, the more they invested. As more and more people were getting invested, this exploded with popularity. And as the story gained popularity, more people were investing and the cycle continued. The difference with this was, no one was selling. It was Wallstreetbets' mission to destroy Melvin Capital. And instead of sticking to strict risk management like I talk about on this channel, Melvin Capital refused to close out their short position. And as a result, the price of GameStop went from $19.95 on January 12th to peaking at $483 today. That's a 2,321% rally. And along the way, Melvin Capital refused to close out their short positions, thinking that this fad would just fade and they'd still take in profit. And here's where it gets really complicated. Instead of just closing out their position, Melvin Capital was bailed out by two different hedge funds. The first was Steve Cohen's hedge fund, Point72, and the second was Ken Griffin's Citadel Securities. Citadel? I've heard that before, but where? Citadel is the largest customer for Robinhood's data. And the trading app Robinhood just got fined $65 million for misleading their users on how they were making money. They actually just sell your order flow to Citadel seconds before the trade executes. Citadel uses this Robinhood data along with high-frequency trading strategies to get filled at slightly better prices. This is called front running, and they can do it with all the Robinhood trading data. So what does Robinhood have to do with this? Chances are you already heard. On Thursday, January 28th, Robinhood, followed by a couple other brokerages, completely restricted new buy orders for GameStop, BlackBerry, and AMC. If the price of GameStop never came down, Melvin Capital would be at risk of bankruptcy. And if they go bankrupt, they can't pay back the bailout that Citadel gave them. And if Citadel loses money, well, they're not buying as much Robinhood data. All of this is connected. And this is the part of the story that sickens me. Robinhood and those other brokerages tried to spin the story. They said that they put in those buying restrictions just to protect their customer base from large losses. Basically just calling their entire customer base too dumb to understand the financial risks that they were taking with their own money. In reality, they were just protecting their largest customer, while their users, us investors, were locked out of the free market. And when this happened, the price of GameStop went from a pre-market high of $500 to opening at just $265. Amazingly, even without the help of Robinhood traders, during the day, GameStop's price ran to $483. Unfortunately, it was crushed later in the day and closed at $193. This was a 61% drop from the pre-market highs. And they weren't the only stock affected. AMC closed 57% lower today, and BlackBerry was down 41%. Tough for the little guys to get ahead when the bullies can change the rules in the middle of the game. I didn't personally go long on any of these stocks, but I'm disgusted that we're now censoring investing. It's gross that Robinhood frames their business as a place for the little guy to get ahead, when in reality, they're no different. So where do these short squeezes go from here? Your guess is as good as mine. I did just see that Robinhood will be allowing restricted trading on these names on Friday. Most likely they're putting these restrictions on so the price goes even lower, and those call options don't get executed, which would spike the price again. This was a terrible day for personal investing, a terrible day for financial freedom. But it should be a big wake-up call that as American citizens, we're not educated in any of this. You had to come to my YouTube video and ask, can you explain this to me like I'm 5? If you enjoyed this video, please leave a like and share this video with your friends to bring them up to speed. And if you're interested in more trading content, subscribe to the channel. I make 3 trading videos a week, a breakout watch list on Sunday morning, a live stream on Wednesday night, and a full trading recap on Friday. Thanks for tuning in, and I'll see you soon.